I think we're going to lower rates in a big way. I don't think silver prices would be here at $40 an ounce in that environment. Mark my words on this. The biggest risk for an investor in the space is going to be how to hold on to your shares in the middle of a bull market. Because I think we are using perspective from prior cycles into this and saying, well, these things are getting frothy compared to what we saw in prior cycles. This is a very different cycle.
Does it look like a bubble to you right now?
No, not a bubble at all. I would argue very much against that. I'll probably be one of the first guys to admit if we are in a bubble. I don't think that's the case at all.
Right now, pretty much every single asset class that we can think of, except maybe oil, has been ripping higher. Stocks, gold, precious metals, gold mining stocks, which we'll talk about in detail, Bitcoin and cryptos. Probably the biggest bull phase right now since early 2021. We'll talk about why, and we'll talk about what's next with our next guest, Tavi Costa, portfolio manager at Crescat Capital, and he's predicting a huge surge in the resource sector. He's been right. Welcome to the show, Tavi. It's good to see you here at the Precious Metals Summit in Beaver Creek.
Thanks for having me, David. Yep.
I want to start with one of these slides here you've got in your presentation at crescat.net, stages in a bubble. And you've got here the timeline. We can show this on the screen for the audience here. Valuation timeline. Despair is the latest point in this particular chart, followed by a return to the mean. What stage are we in right now?
We're definitely at transitioning from the stealth phase into the awareness phase. And that's exactly where institutions are starting to ask questions, they're starting to deploy some capital. I think that what is interesting about the mining industry overall is the complexity of this industry makes it very difficult for institutions to deploy capital. So it takes a little time. We've been in this smart money phase for the last 3-4 years of people accumulating. I will include myself into that, accumulating in those assets over time. And now we're starting to see the movements, but the leverage relative to metals is still a long ways from a peak level. We're really at the very beginning of a cycle, in my view. It's extremely exciting if you've been investing in the space. We've finally seen some validation. Companies are making money. Most of the mining companies are seeing cash flows like we've never seen before, especially given where gold to oil ratio is, and most of gold to, or any metal, even silver relative to energy costs, is what is causing this huge run up in their margins. And so I suspect that as a mining company, you want to hedge that energy risk, in my view as well. But there's probably another 2 to 3 years of very interesting performance for this whole industry.
Does it look like a bubble to you right now?
No, not a bubble at all. I would argue very much against that. I'll probably be one of the first guys to admit if we are in a bubble. I don't think that's the case at all. I think we're coming off such depressed valuations that people have just not made money, and everyone is just excited about making some money. That excitement may be sometimes confused with potentially a bubble, but that's not the case. I mean, we're still in the beginning.
What about tech stocks? We've got a slide here showing how the Mag 7 stocks have been increasing in terms of their median enterprise value to free cash flow on the top panel of the chart versus their aggregate net cash balance, which has been going down. Yeah, I wonder if that signifies an overvaluation or an extension of valuations.
Yeah, no, that's a frothy environment right there. That side of the market in the tech space is certainly very expensive, different from the mining industry. I would argue that that's one of the reasons for it. Certainly AI has been changing and attracting a lot of the money into that part of the market. What I would say is that the valuation of these companies, as they see some deterioration of the balance sheets, I think would be the big question, how the market will treat it. I also think that this is going to unleash what I call a world of spenders versus losers, versus earners. The spenders are likely to be the Mag 7 companies and the other technology companies. The earners are going to fall into 3 categories, in my opinion. Probably energy, number 2, infrastructure, and 3, materials, mining being one of them. And so the big question for the size of the technology space is how will this frothy valuations behave when you start seeing these companies really leverage their balance sheets? They actually don't have any debt in their balance sheets yet. On an aggregate standpoint, they actually have net cash in their balance sheet.
Yeah.
So imagine that turning into debt, let's say 30-40% of their balance sheet in debt. That's trillions of dollars entering in these other areas of the earners. And so spenders are going to spend, earners are going to compound earnings. And so I'm super excited about the other side of it.
The Freudian slip earlier, spenders versus losers. If you don't spend on investments right now, you're probably going to lose out on an opportunity. Well, let's talk about that. People have been asking me, both here at the conference and personally offline, hey, is it time to sell my holdings, especially in the precious metals?
No, I don't think that's the case. There's some real big forces happening in the space. AI, just to touch on that again, is very different than what we've seen with the internet or the real world revolution in a huge way, just because the amount of infrastructure development we're going to see here is comparable to some of those other parts in history. What is not comparable is this arms race, this need for somebody, a country or a company to get there first. And that race is what will catalyze the spending on construction, in my opinion. Construction is running at about 7% of GDP. We could see double of that amount.
Construction for what? Data centers?
Construction spending overall, that's including residential and non-residential, is at about 7% of GDP. And I would suspect that looking at history on that data alone, we can probably see a double of that amount, 14% or so. That what used to be in the 60s. And so they're very plausible. And so you have to think about, all right, well, those are trillions of dollars coming into all sort of industries. And a lot of people are questioning, can the tech industry or the tech sector really finance that? I certainly think it's possible. I mean, on their free cash flow alone, about 85% of what they generate in free cash flow is going back to shareholders. It's going through buybacks and dividends. That alone could be about $500 billion every year that could be coming into all sorts of infrastructure spending. So that's going to be very, very exciting. And then the industrialization that is happening, I would say that the mining industry will benefit tremendously from that. And what's happening with the government also, trying to infuse capital in certain companies, MP Materials and others, the engagement of the government, which I think is very negative from a macro standpoint. But we have to see as well that cash is coming into this industry in a large way, and will have an impact on valuations too. So certainly not a bubble in the mining industry, in my opinion.
We're speaking today on the 9th of September. Over the last week and a half, stocks have ripped higher. Gold is hitting new all-time highs, $3,600. Silver, $40 an ounce for the first time since 2011. Everything's just soaring higher. Bitcoin now above 110,000. So the question is why? What happened in the last 2-3 weeks? One interpretation is that the expectation for the Fed to cut rates by September, the next meeting, which is next week, is higher now, especially after Jackson Hole. Is that the only reason?
I mean, we're in a funny world. Inflation is reaccelerating. Everything you said is very inflationary, especially if you look at the hard asset space. Gold is obviously, at least in my view, is probably leading inflation data in a big way, maybe a year out. And so I suspect we're in a world where inflation needs to run hotter than expected. Scott Besson has said many times, we got to grow our way out of this debt problem. That's just a code word for inflation. We're going to inflate our way out, and we're going to have to suppress rates. And so what is basically becoming a policy unavoidably is the devaluation of the dollar versus other fiat currencies. What I think people are missing here is that this dollar movement, we've seen one of the biggest declines of the DXY index since the 70s, specifically 1973. And the question is it the beginning of a big downward movement or an exhausted move? And I certainly think this is a long-term problem. And as we see that becoming more pronounced in markets, I believe that that's going to catalyze other ideas, such as emerging markets that no one is positioned for. That to me is one of the most asymmetric opportunities in markets right now. Energy as well. I think you said it well. Energy has been lagging everything. And so I happen to have a very constructive view on energy right now. I mean, if you like energy companies and you're not bullish right now, I'm not sure exactly what type of analysis you're running, because it's they're making money. These companies are certainly one of the cheapest levels we've seen in history, and I would suspect that that's also going to become a big part of the onshoring and AI story as well.
I want to come back to emerging markets, but going back to what you talked about earlier with inflation, you have a chart here showing inflation then versus now. Inflation has come and gone in cycles and waves, and then they're drawing a parallel here between 2015 to today versus 1967 to 83. And it looks like it's about to repeat. If you overlay those two lines, it's about to repeat a third wave of inflation.
Yeah.
Is there a fundamental story as to why that third wave could come back?
Yeah. By the way, that chart looks, I think looks great, but it makes you think that we're into the very last third phase of inflation. That's not my view either. I think inflation is reaccelerating. The Fed is forced to lower rates and allowing inflation to run hotter. That's going to reaccelerate inflation normally. And I think that that's going to be very positive for hard assets. We're in a world where, although we're comparing with the 1970s, the world back then was very different than now. We were not running, for instance, a very steep current account problem. So there was no deficit on the fiscal side, or not a severe deficit on the trade balance side. There was no debt problem. We have those three issues now, and those three issues eventually cause what is called fiscal dominance, which is essentially lowering rates to allow your government to pay down your debt. And you don't do that with a strong dollar. You have to devalue the dollar. And so that's where emerging markets come from. If you think about from an investment standpoint, the two largest risks of investing in emerging markets are higher yields and higher dollar. We may see the opposite of that in this next 5 to 10 years. And so I firmly believe that while a lot of folks are paying attention to the corruption and all the differences we have in emerging markets, those structural problems are not going to change. What's going to happen is the capital flows that are exhausted already into the U.S. markets is likely to start switching and coming into, especially Latin America, where I think it's going to be one of the biggest beneficiaries.
So you said that the dollar going down would be beneficial for emerging markets, yes, because most of their debt, I'm guessing, is denominated in dollars, and so their interest expenses will go down.
They're not as levered as a lot of the other developed economies are. They're going to be forced, meaning the U.S. will be likely forced to lower the valuation of the dollar. In other words, devaluing the dollar versus other fiat currencies, not just gold. That's already happening. And I think it's important to pay attention to the gold trends historically. They usually lead emerging markets as well. Early 2000s, 1970s. So I think this is just the beginning. Gold has done the green light. And it's all about an acceptance of risk exercise. Gold is much easier to understand. It's a large market. It has volume. Central banks are buying. And so it's easy to get behind that. The second, other derivatives of gold are starting to move. You've seen silver, copper, miners. It started with the royalties, coming down to the seniors, now going down to the juniors. Well, that acceptance of risk is naturally taking place, and the next step of that is going to be emerging markets, in my view.
Which sectors, equity sectors of emerging markets would you prefer right now?
Well, I like Latin America for many reasons. They have very heavy commodity-based economies. From energy to mining, even agricultural commodities as well. But I think you're probably, if you look at let's just use Brazil as an example. You can look at the banks. Brazilian banks are trading at one of their lowest multiples we've seen in history. And, indirectly or directly, those companies are going to benefit from this trend. And so I don't think you need to go down with volatility on liquidity risk, as I've been deploying more capital into the mining space in lower liquidity instruments. I think emerging markets, you can go into the liquid names and potentially have major uplifts when it comes to valuations. The valuation disparity between Brazil or any other Latin American economy versus our business relative to the US is one of the worst we've seen in history. And remember, all these changes we used to talk about state-owned companies and all the issues about the engagement of the government in those areas with the private sector is also happening in the U.S. So what's the big difference between these two economies now? All I'm saying is the spread between the two in terms of the political involvement in the private sector is definitely shrinking substantially. MP Materials receiving capital from the government. Those are things we usually see during war times, and that type of equity deployment into the private markets. And so I think that's going to change. And people are not thinking about it. These equity investments, administrations come and go. Like 4 years from now, we may see a change or 3 years from now, a change in administration in the US, well, that equity position of the government is staying. So what does that mean? As we see a more socialist agenda in the future, how is that going to be impacting the decisions of those companies with the government owning 10, 20, 15%, 30% of their companies? I think that's an important question.
This is all predicated on the assumption that the dollar index is about to decline. You have a chart actually showing the DXY index making higher lows and higher highs ever since the beginning of the 2010s. And there's a white arrow pointing down in the latest data point. Why?
Because I think that, I learned this from watching Paul Tudor Jones many times, that the real money is made on understanding and predicting the breakouts or breakdowns rather than waiting for them to occur and then piling on the trade. And I think there's a very plausible case to be made that the dollar needs to go a lot lower in the next 3 to 5 years. And if that's the case, that's going to mark a major breakdown in this chart and potentially the beginning of a long-term trend on the downside. And I think that people are just not expecting that at all. I mean, some of the dollar trades have been a little more crowded on the short side, but emerging markets remain extremely under-owned. So you can kind of see where you can express that view in markets. And once people realize that the dollar cannot get stronger and yields cannot go higher because the government cannot afford higher yields, then that's where emerging markets is going to become more and more clear.
So one bullish narrative for the dollar is that, this is from Scott Bessent himself, U.S. Treasury Secretary. Stablecoins, the emergence of stablecoins is going to put a lot of tremendous pressure on dollar demand. Stablecoins are going to be backed by treasuries. So there's going to be more treasury demand, more dollar demand. And the future of payment rails is going to be on stablecoins.
Look, I agree. They're going to find ways of funneling capital into the treasury market. What the issue I have with that view is that if you look at what's been happening with global yields, let's just use the 10-year yields across the globe, year to date. We talk about the Mar-a-Lago Accord. What is the Mar-a-Lago Accord? I mean, why is the U.S. yields basically stagnant year to date, 10-year yield, and every other yield across the globe is going higher? I think that's the Mar-a-Lago Accord right there. It's allowing the yields to go higher and supporting those currencies, because the differential of those interest rates, Japan, any place in Europe, Canada, Australia, Brazil, if they are higher than the interest rates in the US, or at least on a relative basis moving higher, that supports their currency. And that's exactly what we're seeing. There's a reason why there's a correlation between this movement on divergence between yields and the weakness of the dollar. And I think that's only getting started. I don't think that's the end of it.
What we're seeing, what you're describing, supports the Trump administration's agenda for a weaker dollar during his term. And so we're seeing that playing out exactly as they expected. Does that mean a stronger export sector for the U.S.?
That means what, sorry?
Does that mean a stronger export sector for the U.S.?
Yeah, I mean, if you think about it, a lot has been said about the fiscal problem, but not a lot has been said about the trade balance issue. And structurally speaking, I think it's the first chart in my letter, actually. Structurally speaking, we're facing one of the worst trade balances in history. I think the only time we've seen this was in the 1800s, but the U.S. was an emerging market at that time. And so there was a reason for that. And we were receiving a bunch of capital. We were importing so much at that time as well in order to grow the economy. And now we're in a very different, more mature stage than back then. That's not the end of the U.S., nothing like that. All I'm saying is these capital flows come and go. And we're probably onto the beginning of a cycle where elsewhere outside of the U.S. are probably going to outperform the U.S. itself. And so I'm very bullish on particularly emerging markets for that reason.
The U.S. current account as a percentage of GDP is the first chart you're referencing. It's currently at negative 5%. This is the worst since the early 2000s. What does this mean for markets?
Well, it means that we're, and by the way, that time was actually, the chart is labeled, although it looks like it's early 2000s, that happened in the global financial crisis.
Oh, 2008.
Yeah, but in global financial crisis, what is interesting about that chart is that was because the GDP was collapsing and you had that deficit becoming more extreme. Today, it's much more structural. There's no recession and we're still seeing the decline. People don't think about it, but a government or a country works just like very similar to a company. If you think about it as a company, your streams of revenues from a government standpoint or from a country standpoint are two things. you either bring in more taxes than what you spend from the fiscal front, or you either export more than you import. We have a twin deficit problem. So we have a deficit on the trade side, we're losing money on the fiscal side. And so that is basically exponentially growing the debt. And at the same time, you have the dollar at its most overvalued levels we've seen in the last decades. And so those things don't go together. Something's got to give.
In terms of portfolio positioning, you told me offline, you're structurally bearish, although you're not playing it like that right now. You're still long a lot of the resource equities, right? A lot of these charts on your slide deck support possibly a bullish thesis, if you want to call it that. The U.S. money supply going up, for example, is one such chart. If we have more liquidity, doesn't it stand to reason that we'll have higher equities prices and valuations? Higher inflation, all things be equal, should also be good for equities. Yeah, equities are a direct hedge to inflation. So structurally speaking, why are you bearish right now?
Well, it's funny because when we talk about equity going higher, equity markets, but look, the gold market has by far outperformed any other sector of the economy year to date. And to me, that's much more compelling as a case than focusing on trying to find the other side of that market in terms of the outflows from the very frothy parts of the market. I feel with very high conviction that the risk doesn't justify these valuations in the tech space at all. I think that's extremely expensive. And the capital that they have built over the years is probably going to rotate into other parts of the market. And so I'd rather focus on the earners. As I said, there's spenders and earners. I'd rather focus on the earners in a huge way. And I don't want to bet against liquidity. I mean, liquidity is going to be here for a while, most likely. And, I don't think there's a way around it. And as we see liquidity continue to come into the space, it's probably going to look for ways that have been very neglected. What are those parts? Mining is one place. That's why when people ask me, are we in a bubble? I'm like, we haven't even seen anything, guys. I mean, this is just the first year of good performance relative to gold. We need to see multiple years like that in order to get into a bubble environment. We're not there. So
does it frighten you how fast the GDX has run year to date, 90%, and you have a chart showing gold miners year to date performance outperforming every other S&P 500 sector? That wasn't the case last year, by the way.
Yeah, no, I agree. No, I think it's shocking. Yeah, I mean, it's nice to see that occurring. It gives you more conviction.
As a portfolio manager, do you see that to yourself and say, whoa, it's time to take profits?
No, I don't think so. I think here, I think the biggest, mark my words on this, it's my view on this, okay? I think that the biggest challenge for investors in the next decade, if you believe we're in a mining cycle, and this is getting started, where you see mining companies are starting to outperform gold, which is just at the beginning. If you look at that chart of GDX relative to gold, we're like 60% lower than we were back in 2011. I mean, we're nowhere close to that level. And I think we're going to break out. But I think the biggest risk for an investor in the space is going to be how to hold on to your shares in the middle of a bull market. Because I think we are using perspective from prior cycles into this and saying, well, these things are getting frothy compared to what we saw in prior cycles. This is a very different cycle. Capital spending is extremely depressed. There's no major mining projects coming online to change the supply curve. We know that there's a lot of capital starting to come into the space. There's a need for this given the onshoring and AI. AI is an arms race. It's not an option to spend. They need to spend. It's almost like a threat nationally, between China, US, and other economies. And so, this is, to me, this is just the beginning. This is going to be a very exciting next decade in the space.
The last time we had a huge bull run in the gold space was 2020, right after the pandemic, right after QE. Before that, it was 2011, and then you knew what happened after that. We had a multi-year low flat line in the gold sector, kind of just, trucking along for 8 years or so. What's different between now and 2012?
Everyone asking that question, like, why are we in the bubble or why we're close to the end? It's like, not to be disrespectful at all, but like, honestly, I think that the whole industry is asking those questions as well. And it's normal, natural. All of us have in the space, although we've done very well in the last few years and we're blessed on performance, but I know that the whole space has been very in the hopes of performance, and now finally we're seeing this excitement coming into this whole industry, and I think it's just the beginning. I really think that we're just look at the fact that no one is really pounding the table on silver. Yeah, I mean, the silver is trading at above $40 an ounce, and the gold to silver ratio is at 80.
Yeah.
I mean, that's one of the most bullish greens, lights I've seen in my probably my career for the metal. And so, this is outstanding. While a lot of people are saying, well, silver is not really moving as it's supposed to be moving like gold is. It's just normal. Just, let the thing take its place, and it's absolutely normal. So I'm very excited about this whole space.
What are some common questions you've been getting at this conference so far? Well, I know it's only been 3 hours in. Yeah.
No, I mean, look, I think there's been a lot of questions about positioning, about the fact that we're maybe seeing, a lot of excitement and valuations are starting to creep up, and there's a lot of people asking for money, and there's a lot of capital raises. But at the end of the day, if you look at the indices, major indices, how many mining companies are in the S&P 500 today? How many gold companies are in the S&P 500? Can we have 10 of them in one day? I mean, why not? No, I think we're selling ourselves short here.
Is there interest from institutional players to add gold mining companies to their portfolio? When are we going to see, a mid-tier in a pension fund, for example?
Oh, I think it's going to happen very, very soon. I think all these places struggle with the complexity of the industry to come up with reasons, justification to really invest in this industry. The fact, if you look at most of these projections for gold prices, at the end of the day, when you value a gold company, you're looking at projections for gold. Majority of the projections for gold are still at 2,500. Long term, that's not my view. I think we can see double that in the next 5 years.
2,500?
2,500 is where the projections are. I think we can see, why not 5,000 gold prices in 5 years from now? And
well, $3,600, 5,000 doesn't seem so crazy.
Well, I think if you look at valuations, majority of the mining companies are still trading like gold prices are at, like I said, maybe even at 1,500. Yeah. And so look at the cost curve of these companies. All-in sustaining costs in average is still sub 1,300 for most of these companies, and they're producing at $3,600 gold prices on the top line. And so these margins are insane. And look, it's wonderful. And then people are going to start seeing the cash flowing side of it. And that's when institutions start to really deploy capital. We haven't seen the M&A, the real M&A excitement yet. I mean, that's still coming. The juniors are still really cheap. And so, yeah, this is a world that is only getting started. Notice the behavior of some of the junior companies beginning to perform better, especially when gold prices are down. That means that the institutional capital is finding its way into some of the places that, again, accepting more risk. They're taking more risk, and they're being okay with that because they think gold prices will be here at these levels for the long term. And so, look, this is very, you buy a mine today. When you go buy a car, for instance, you buy a new car, next day that you bought that car, the value of that car is down, 30% or so? Normal, right? Everybody faces that issue. Today, you buy a mine, it's the opposite. You buy a mine at the price that is the valuation of these mines are still at $2,500, $2,200 gold prices. Yeah. The day you buy that, you got a huge uplift on your valuation just because gold prices are actually at $3,600.
And so here's a longer term issue that I don't know if we've thought about yet. So right now, people are telling me it's a little bit harder to make discoveries, peak gold and all that. It's a little bit more difficult to drill, more costly to drill. All right, so a typical mine life, 10, 15 years. What happens in 20 years, Tavi, when most of the mines right now are near depletion and it's getting more and more difficult to find the replacement?
Well,
20 years.
Let's think this through, right? I mean, there's some outstanding companies. There's too many companies in the mining industry.
Sure.
95% of them should probably be worth zero.
Okay.
And the other 5% have high quality assets. Your job as an investor in this industry, if you're in this part of the Lassonde curve, the left side of the Lassonde curve, is to figure out which ones are those 5%. Now, I would say that 75, 80% of them are probably very easy to figure out that you shouldn't be investing. And then the other 10, 15% are probably a little more tricky, 20%. And so that's where your challenge really is. Those companies that you just mentioned, not that you mentioned any names, but that part of the industry that has high quality assets and exploration side are probably going to be beat up. And it's the end game for those companies most likely. So 3 years ago, we decided to start deploying capital into that 5% that we thought were the high quality assets. And, things are starting to turn in a huge way. Another aspect that I would go back to is an analog of the 1970s. The 60s was also a period where we didn't see a lot of discoveries. There's a lot of issues there. And in the 70s, we saw gold prices rise. Mining companies did very well. But the 70s, we didn't see a lot of discoveries. That's why we saw this kind of 10-year period of bull market in gold prices too. Now, subsequently, 1980s and 90s, so after the bull market, we saw so much money coming into this industry. Market peaked. And then we saw an age of discovery. Capital was still there. And so companies went chase new discoveries, and they found a bunch of new discoveries in the 80s and the 90s. So I think we're maybe a decade out or maybe 5 years out of another discovery phase. That's going to happen too. It's going to be a natural part of the process here.
Okay, I'm going to finish off we have 2 minutes left. I'll finish off on a two-part question. So what do you think the Fed's going to do into 2026? And second part of the question, is monetary policy, aka what the Fed does, more important or less important than fiscal policy for your investment decisions?
I think monetary policy has become fiscal policy. You have to lower rates to allow the government to pay its debt. And so it's going to be a very tricky game to allow rates to ever rise. And if you're in that environment, you're probably going to let inflation to continue to run hotter, and liquidity will continue to come in, and market and money is going to find its way in things that I believe are neglected and cheap and that are starting to move. As far as the Fed, look, I think that there's, a reason to believe that they may not lower rates this next meeting. And the main reason for that is Fed could take the political route, or it could just say that inflation is running hotter. We're seeing data that inflation is running hotter than prior months. And that could be justification to maybe not lower rates like the market is expecting. Now, 2026, as you asked me the question, I think we're going to, unavoidably lower rates in a big way. And that's going to be, I don't think silver prices would be here at $40 an ounce in that environment. So, I don't know, that's the long-term more medium-term, long-term view. Very, very short-term, we may see a little, I'm not trying to make a lot of money in these types of predictions, but I'm very open-minded to that. And I think that's how investors need to approach this. If we see a pullback caused by that, I'm going to be a buyer, because I think that they're going to go back and lower rates.
Lower rates in the big ways. Is that bullish or bearish for markets? So I've heard the opinion that it could be both.
It depends. If they lower rates in an economy that is hot and inflation is right, then it's a different story.
Yeah.
We're a little bit stagflationary right now. It's I think the jury is out on where labor markets are. The data is difficult to judge. There's maybe some issues with the data, as Trump has pointed out, and maybe even more issues now with a new person coming in and readjusting the data. Do we believe in that or not? I mean, it's difficult. But at the end of the day, liquidity is coming in and inflation is coming back. You can see, I think copper is, had a huge pullback, looks extremely cheap. You have other commodities doing very well. Energy looks very cheap. I like people to remind people about the dynamic that is very usual of a commodity cycle. It's a rotation. We rotate into things. And I think we're yet to see the rotation start to become the spotlight for energy and agricultural.
Well, I think people should rotate to your social media and your website and see what else is you've got. So where can people follow you?
They can follow me at Tavi Costa on X.
Yeah.
And our website is Crescat.net as well. And you can find our letters there. And they can rotate back into your YouTube.
Awesome. All right. Well, we look forward to that. Thank you very much, Tavi.
Yeah.
Thank you for your time. Thank you for watching.